Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
Hey, Daniel, I was thinking about recently about these craziness that's going into market, into market, the volatility we talked about on shows before and that kind of thing. And I'm very concerned because the market is down significantly from the peak in January. And, I began thinking about people and what people are doing out there. And I thought about these people that came in recently, and I was looking at their accounts and seeing how, they said, Andrew, we got all this money wrapped up in 401k plans. We got $400,000-$600,000 wrapped up in 401k plans, and I'm concerned about it. The wife said, Andrew, I was so scared during the coronavirus that I pulled my money out of the market and put it into the more secure investments within my 401k, but they haven't been doing anything. And I'm tired of this, and we're 2-3 years away from retirement. And I want to make sure that we hang on to this nest egg that we built. We built our money pretty well, but now what? Now, what do we do with Andrew? We got money in the bank. We sold our house. We have money in the bank. We have money in secure investments in our 401k, but then we have some money in the market, and there's got to be something between the bank and the market where we can put our money. What now, Andrew? What now? I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about you won the game of life. What next? Dad, we hear that quite often. I feel like there are many, many ways for people to understand dollar cost averaging, right? Systematic investing, building your 401k, saving for retirement. And then when you get there, it's like, well, now what do? I've built up this wealth. Most people who've built their wealth, we're going to exclude Elon Musk, right? Because the guy's crazy. He makes $200 million and then decides to put it into two companies that he thinks will both fail, right? A rocket ship company and an electric vehicle company that had, until him, never succeeded, right?
Right.
Except for him, most people, once they accumulate their wealth, they want to put it in somewhere where it's protected, and then allow that to support the lifestyle that they want to have. So they can, what do you build up wealth for? You've built up your wealth. You've generated all this. You've worked hard to build the money so that you can trade it in for lifestyle chips, right?
Right.
You're not interested so much in dollar bills. You want the lifestyle chips because you want to be able to go on the vacations you want to go on when you want to go on them, support the causes you want to do if we're in a recession or not in a recession, take care of your family, see the people you love, and start the hobbies that you either never had time or money to do, right? Those bucket lists that you've built up.
Right.
So how do you do that with confidence?
How do I do that with confidence? We do that with income, right? We get a paycheck that's from our assets, make our assets work, make money work, put it in the sweatshop where it's working hard so that you can be on the beach sipping pina coladas. But Daniel, too many times people got their money sitting on the beach sipping pina coladas. I think of a client came in this week and they got a lot of money, sold the house. This different client than earlier. These guys sold the house. They got money in the bank. They got a bunch of money sitting around at 3% or less. And the money is sitting on the beach sipping pina coladas. And, I'm concerned because some people they just keep going in this fashion. And that's the thing that can make people run out of money. But, I like what you say about these lifestyle chips. That's one way to put it. But the idea is that we all have a lifestyle we want to live. Some of us are living that lifestyle and not in retirement. Well, you certainly don't want to give up that lifestyle when you go in retirement. And some people are pushing off retirement until they can be sure that they can have that lifestyle in retirement. And that's the people that we're talking about today, because a lot of people out there have won the game of life. They've gotten to that point, but they may not know that, or they may not know how to actually do that, because getting to that point is one thing, but then having that lifestyle in retirement is a whole nother factor.
Yeah, in order to have that confidence, right? In order to have that confidence to maintain that lifestyle.
Yeah.
Because so many times we hear people say things like, well, I don't want to run out of money, or how do I know I won't run out of money? And what a lot of big financial institutions do, right, that are geared towards wealth accumulation, right?
Yeah.
They'll run things like, Monte Carlo simulations and things like that. and
Fiction based upon fact.
Well, it sounds really good because it's a computer program that runs millions and millions of simulations, right? But it's just running it on the data you put in. So what is going into that? Is it backdated? Is it history from the last 5 years where like the numbers have been unreal? We've been living in Stupidville as far as valuations go.
Yeah.
Or is it using 100 years of history? Is it using 200 years of history? What data are they putting into that? Because it doesn't matter how many scenarios you run unless you know what data it's running.
Right. Fact based upon fiction, right? The computer can figure out anything you want it to figure out, and it will be factual. But what is it based upon, right? Like, figures don't lie, but liars figure, right? And it's the same kind of thing, right? So, not only is it, what are they basing this thing upon? And so many people put credence in that, but not only is it how the money is invested, but how the money is going to come out. And that's the whole point. People have built their wealth, and now they want to say, how am I going to have this money do what I need it to do? So many times people think that they need $1 million, $2 million, $3 million, $5 million to live the way they want to live in retirement. And you look at Monte Carlo and it's going to say that, or you look at different computer programs and it's going to say, somebody at $500,000 that they're going to need, that they have to live the lifestyle, they'd have to have $2 million. They say, how am I ever going to get there? Well, that's not necessarily the case. That's not necessarily the case if you're getting the money properly, if you're taking it out. And so many times the other bad thing about those Monte Carlo systems is that they say, well, as long as you live to 93 years old, you'll be okay. But what happens if you live to be 100? You know how many centenarians there are today? I can't tell you how many clients I have that have parents over 100 years old. It's crazy. And Daniel, I don't know if you realize that we have several clients who are 95 years old, right? That they started with us in their 70s and now they're 95 years old. And, so if, according to those Monte Carlos, they ran out of money. And so you have to do something differently. And that's the case. But listen, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, hey, you've won the game of life. Now what? And we have a white paper that we like to put in your hand. We have this paper that we designed for this that we think will help you. And what it's called Why Investing in Mutual Funds Could Jeopardize Your Retirement. So a lot along the same lines of, a lot of times the Monte Carlo scenarios use mutual funds or those kinds of investments for that. And if you depend upon that in retirement, well, yeah, you're basing fact upon fiction at that point. We'd love to put this in your hand to help you understand what you don't know, because Financial Strategies that Andrew and Daniel Agemy is all about, because people don't know what people don't know. And we want to educate you in this. So we got this white paper, Why Investing in Mutual Funds Could Jeopardize Your Retirement. If you like that, please call us at 800-725-7616. No obligation. And we'd love to put that in your hand. Daniel, I love that story that you said about Elon Musk, throwing all this money into these companies. And then, but not too many people are in that position. Most people, once they've earned their money, their biggest concern is to hold on to their money. And I talk to basically 99% of the people I talk to are people in or close to retirement, 50 years old and older. I ask them the question, at this point in life, do you think you're a conservative investor or aggressive investor? Many times they'll say conservative or they'll say moderate. Typically, they don't say aggressive. at that point. And when I ask them their definition of conservative, they say that their definition is not losing principal. Everybody wants to make money. So we're not talking about how much you're making, but their definition is they want to make money, but they don't want to lose principal. And that is a key factor here with what we're saying. Okay, so now that you've made your money, you don't want to lose it. Now, what do you do about that?
Well, you buy an S&P 500 fund because that's a bond proxy, right?
Yeah. Well, what's so funny, I think, is, Daniel, people will typically say, well, I have to be aggressive. I only have 500,000 and Monte Carlo says I need 2 million. And so I have to be aggressive so I can earn some money. And if that were true, it wouldn't be aggressive. If it were true that you were going to make money, right, it wouldn't be aggressive. It wouldn't be risky, right? So
by definition, that's a funny one. That one comes up all the time, and you just got to stop and think about that for a second, because if more risk always equaled more return, it would not be more risk. It would not be more aggressive.
Exactly. And how many people did that, right? They put their money more at risk, and the markets hit their peak in January. Basically, we'll call it January 1st of this year. And they've been off it.
The peak was which peak? The peak from like October, November of last year.
Right.
Yeah.
Right. I mean, the highest that it's been
this year. Yeah.
Well, the highest it's ever been. Well, let's call it December 31st of 2021 was the highest the markets have ever been as an indice, right? The markets in general, the S&P 500 or the Dow, that kind of thing. And now we're off substantially, double digits. Basically,
I mean, the NASDAQ dropped 4% yesterday.
Right. So the point being here is, how many people have their money in their market? They've given up 9 months of growth at this point. They've given back to the stock market 9 months worth of growth because their money is not set up to protect it. Their money is not set up to make money in all situations. That's
okay. And so now, before everybody beats us up for saying that, This is why we talk about time frames all the time, because if you're 27 years old, that doesn't matter one single bet, right?
Right.
If you go for that, if actually it's a buying opportunity for you.
Yep.
But if you are 57 years old,
right,
do you want to wait, right? Because there's been lots of periods of times where markets, indices, the index, the NASDAQ, the S&P 500 have not made any money over 10 years, 15 years, right? 18 years,
20
and
years.
So are you willing to either not have a lifestyle for that period of time or put retirement off for that amount of time? And that's why before people beat us up on this, the time horizons totally matter. We're not talking about next Tuesday, right? We're not talking about planning a retirement week by week. We're talking about having a retirement that you don't have to stop your retirement because the information that went in Monte Carlos didn't work out right.
Right. Exactly. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We have to take a break now. But before we go to break, we'd like to give you a book. It's called Common Sense Income Strategies by our friend Mike Easom, CPA and PFS. And we'd love to put this in your hand. It's an excellent read. People are loving this book and enjoy it a lot because it's a great education to help you be able to understand how to have the retirement lifestyle that you want and get the most amount of money that you can, the most amount of income that you can. And so we'd love to put this in your hand. Just call us at 800-725-7616. Check us out on our website. Contact us through our website, agemy.com, agemy.com. You can ask for it there as well. The two words Agemy, spell our last name. And we'd love to put this in your hand. No obligation, free of charge. And we'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's agemy.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So Daniel, recently my insurance company called me up and let me know that I'll be able to save a significant amount of money on my RV insurance, that they found a different company. And I said, oh, that's really cool. And I said to them, I asked them a lot of questions and did due diligence on that because, insurance, as good as it is, you don't know how good it is until it's time to use it. And then it's too late to do anything about it, right? So you got to make sure you do your due diligence up front. And especially important from the standpoint of, I bought my house 35 years ago, and we put an in-law apartment in so my mother could live with us, insured it through the agency I have currently back, then I had used them back then, and put it in the in-law apartment. Time went on and we changed from this agency to different agencies. And now I find myself back with this agency, and I'm called about talking to them about reducing or increasing rather my deductible on my house. And she said, well, because of the house the way it is, we can do this and this, and this will save you a little bit of money. And I said, well, in the process, I heard what she said. And I said, well, I have 2 kitchens in my house. And I have, these things because I have this in-law apartment. She said, oh, I didn't know that. And what I realized was, even though they insured it back then, they never looked at the house and reevaluated the house. And all those years, 35 years, it passed from one agency to another agency to another agency to another agency. Nobody reevaluated the house to make sure that we had the right premise on which the insurance was built. And I was so grateful for being able to have that conversation with her, because we were able to get the in-house insured the way the house needs to be insured. And I said, well, I'm so glad we had this conversation. She said, oh yeah, so am I. But unfortunately, I was the one that had to be proactive with that. She didn't come after me and say, hey, let's look at that. Let me come out to your house and look at your house and reevaluate your house for you. But, we were able to do that. And so that's significant. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about you won the game of life. What next? And Dad, some people may be wondering, what does winning the game of life and your insurance company have to do with anything?
Right.
I think it's a really important story because there's a lot of stuff going on in there, right? One is things change. Right. And when things change, you need to reevaluate your situation. So a lot of things have changed over the last couple of decades. A lot of things have changed over the last couple of years. And
things change when people retire, Daniel, as well. So change, always 3 things in life are certain: death, taxes, and change. Change always happens. The question is it a good change or bad change? Well, only you can determine that.
Yeah, exactly. So for an example, right, the change in retirement, you're a battle-tested veteran of markets now, right? Because you've gone through the tech bubble crash, you've gone through the great financial crisis, you've made money off of that. Maybe you didn't. Maybe you got scared and you sold at the bottom and you still haven't recovered. But people are in both situations who are listening. Right. I know that there's people in both situations.
That's right.
And but for either of you, and then this corona crash that happened in March of 2020, right?
Yeah, right.
You've made it through all of these, and it's taught you that the Fed has your back, and that as long as you keep dollar cost averaging, you're going to win. Well, when you're retired, where's the money going to come from that you're dollar cost averaging? You get to choose. You could take your Social Security, you could dollar cost average, or you could take your pension and you could dollar cost average, or you can keep having the lifestyle that you want to have, right?
Right.
So what kind of timeframes are you willing to withstand, right?
Mm-hmm.
Just like the insurance. So when's the last time you looked at everything? We've been encouraging, since we started this show, we've been encouraging people not necessarily make changes, but to reevaluate, right?
Exactly.
We've been talking about how valuations have been in Stupidville, how retirees need to invest differently than younger people, right? And how asset allocation is so important, because you need to generate income, but you need to have your assets positioned so something's always doing well, so you could take advantage of the other thing, and that's how
True
you do
diversification.
better,
Yeah.
right? That's how you do better than just generating income, because you go buy a fund and you might not keep up with inflation, right? That's what people's worries are when they talk about income.
Right.
I'm not going to keep up with inflation, but that's where you get that alpha, is by having the different things that are non-correlated. So you're always making money in one of these categories, so you put it into the other one, right? So it keeps your portfolio stable while it's paying you, so you get to maintain your lifestyle, right? So how this relates to your story is you have to check up, right? And then you have to ask the questions. What happens if I need money in this situation? What happens if markets don't recover as fast as they did in 2020 when the Fed bailed out markets, right? What happens if it's a longer recession? What happens if passive flows stop, right? Because earlier you said the S&P peak was in January of this year, right?
Right.
NASDAQ's peak was in November of last year.
Okay.
Why is that different? Well, because the NASDAQ doesn't have as many flows as the S&P 500. So what happens if you go into a recession and people actually lose jobs? Well, the flows aren't happening. So the passive flows into the S&P 500 holding it up are not there, right? So these are all questions you need to look at and think about how they will affect you and protecting your wealth if you are coming up to retirement or you are in retirement.
Excellent. Listen, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And we have a paper we'd like to put in your hand today called the Income Generation Report. And this is how to avoid the perils of the stock market. Now, it's not that we're against the stock market. We just don't think you should do stupid investing in the stock market. We believe in smart investing in the stock market, like Daniel's talked about in regard to diversification, proper diversification. It goes back to the definition of your definition of diversification. We're talking about the proper definition of diversification. And we'd love to put this report in your hand for free, the Income Generation Report. Ask for it by name, calling 800-725-7616. Daniel, I agree with you 100% when you say people need to reevaluate their situations. There have been so many changes, and the stock market is not what the stock market used to be, and the S&P is different than the NASDAQ. And I want to save that oomph about the S&P and such for the next segment that we're going to talk about. But but the point being here is that how you build your money is one thing. What has happened over time is another thing. What you're investing in is another thing. How you got it diversified is another aspect. And then another angle is how, when are you going to need money? And that's not even to mention how people need to reevaluate and see how are their beneficiary designations set up. Right? How many people have their ex-spouse on their 401k plans still as their beneficiary? The ex-spouse will love you if you die, but that's not probably how you want it to happen. Yeah. So anyway, but there needs to be a reevaluation, just like in the story of the house. We need to have a reevaluation, need to be looked at it for what it is now, because once we get to that point, guess what? It's too late to do anything about it.
Right. And what are we talking about when we're talking about lifestyle? What are we talking about when we're talking about lifestyle chips, right? You and I were looking at some charts earlier today that were talking about how much people think they're going to need to live in retirement. And now what people think is probably a lot different right now, because people have these really high expectations of what inflation is going to do. That's partly why markets are so crazy, is because people think one thing, the Fed's doing one thing, and markets are reacting in another way. But we were looking at some interesting numbers, right? And basically 13% of people think that they are going to need $60,000 a year to retire on, right? So if you got some pensions, if you have some Social Security, maybe you can make up that 60 from those two things.
Right.
If you can't, or if you want some room for inflation, then you have to have your assets positioned, right, to generate the difference. And ideally, they're generating more. Now, that's the largest group, right?
Right.
Largest
single group. Yeah.
Right. But the more of an average of what people are expecting, right, was $100,000 that they're going to need.
Right.
So if we say somewhere between $60,000 and $100,000, now each person is different. So this is not for the people who know how much they're going to need to retire on. This is for the people who are they're tasting retire, they're seeing it out there. So how are you going to generate, right, $60,000 to $100,000 a year? Now you could do the math. You put that money in the bank, you're earning nothing. So subtract $100,000 a year, you can retire for 10 years, and then you'll run out of money.
And the withdrawal method, yeah.
Right. So that's not a very good option.
No. Because if you live longer, you're done for, right? You don't want to outlive your money. That's what you're going to do.
Right. So you're either going to have to go back to work, live a lesser lifestyle, put your retirement on hold, or find a different option, right?
Now find a different option now. Right.
Find a different option before you start spending it down.
Yeah.
And so hopefully that gives people an idea. So now when you start looking at market structures, you start thinking, well, if I'm going to be spending somewhere between $60,000 to $100,000 a year, and so each person is different again. So this could totally be different on your situation.
Right.
But you think about those numbers. How are you going to generate that much? And then if you're thinking, well, markets average 8% a year, so no big deal, but averages fool us. And so if there's a 5-year window where it doesn't average anything, or it averages a negative number, where's that $100,000 going to come from? And so these are the things we're trying to get people to think about so they can be protected. And hopefully people have already been making these conscious decisions, making the change in their portfolio so they're not going through the pain, that the bloodbath that's happening currently. Yeah. Right. These retirees and these people who are serious about their retirements. Yeah. But look at this stuff. This is important stuff. Markets are looking more and more like casinos every day.
Yeah, exactly. And, we could just go so far into that, but we need to take a break, and we'll come back and we'll talk about how the markets are looking more like casinos every day. And in the meantime, want to give away a book to you. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We want you to know what's important so you can make smart, wise decisions. We got this book for you, Common Sense Income Strategies by Michael Easom. This is a book that's an easy read book. It's about 150, 200 pages, has a lot of good information in there about how you can understand how to do things differently now that you've grown your wealth. We'd love to put this in your hand for free, no obligation. Call us 800-725-7616. Ask for the book, 800-725-7616. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So here in Connecticut, there's 2 large casinos in Connecticut that at one time was the 2 largest casinos in the world, or 2 of the largest, number 1 and number 3 years ago. I'm not sure how they stand today, but the point is we have a lot of people going to the casinos and going there for entertainment. They'll say, well, I go in with $100 and, that's it. When I use up my $100, I'm done. And it's just a lot of different things. Some people say, hey, I won $500 at the casino. I said, yeah, but how many times did you go to the ATM machine? How much did you take out of the ATM to get that $500? $1,000. So, but you go to the casino and you're there, you're at a table and they say, hey, lay down $100. and you can make 10 or $20, but you could lose 40 or 50. Would you take that bet? I'm Andrew Agemy.
And I'm Daniel Agemy. You're listening to Financial Strategies. Today we're talking about you won the game of life. What now? And kind of sort of what this is about is people have accumulated a lot of wealth. They're close to or they're in retirement, and they're asking the question, well, how do I protect this? How do I not lose what I've built up, either from inflation, through market volatility, or through just good old money printing, right? And so we're talking about casinos, and most people, when they go to the casino, like you said, they want to have a asymmetrical return to the upside. It's not fun gambling if you can lose more than you can make, right?
Right. I wouldn't take that bet.
Or if you can make 8%, but you could lose 50%, right? So how's that relate to investors?
Well, the stock market over the past 20, 22 years or so has averaged 7%. I like what you said earlier, Daniel. Averages fool us, right? Like the 6-foot tall man that drowned in the, on average, 5-foot deep water, because there happened to be a 8-foot place, right? And he sunk into that, and that's where he drowned. So averages fool us, right? But the average of the stock market's done maybe 7% on the S&P 500 the past 20, 22 years. And we know that it never does 7% a year. But the key behind that is that, like what you just said, right? You could make, maybe if that, you make an average of 7% in the stock market, but when you need the money, maybe you lose 20% or 30% or 40%. Is that worth it? Hey, but I got to have my money at risk. There's nothing better to use for inflation, than the stock market. Is that true? Is that true? But, I've done a lot of reviews recently where we've given clients, we talked to clients about how over the past year, they have a double digit, I'll just keep it simple, a double digit return for the retirement income, as far as a double digit increase, a double digit retirement cost of living adjustment to their retirement plan. It's exciting. I mean, Daniel, I don't know if you know this. I talked to somebody the other day. It was a 30% increase. Now I know, talk to people that are 4%, but most of them are double digit over the past year, which is huge, right? When we're talking about this effect. But the casino effect, people are talking. People are listening to the talking heads that are out there, that are not running by a fiduciary standard. Fiduciary standard is somebody that has to do legally what's in their client's best interest. And all these people on the radio and television and so forth are not talking in that way. Sure, we're on the radio too, but we are fiduciaries, right? What makes us different is we are coming from a fiduciary standpoint, trying to educate you guys in the audience to be able to know what you don't know so that you can make smart decisions. But most of these people are not fiduciaries. And so they're coming to you and they're saying, well, this is what has worked in the past or whatever. And that is problematic. That's like a casino, just, throwing your money and gambling it away. And that is problematic.
Yeah, and some people will probably, based on their past experiences, right? Our past experiences shape our realities. Say that's kind of crazy, and they haven't been in the retirement. They haven't been in retirement, or they haven't had a successful retirement necessarily, and so they need to reshape that reality based upon the point of the phase of life they're in now. But
let me stop you just for a second. When you're talking about those people, there's those people that are in retirement, they're successful, but it hasn't been tested. And that's what we're talking about with the insurance thing that we talked about earlier, is that when it's tested, it's too late to do anything about it if it's not set up properly. So the best thing is to go with a specialist, somebody that knows this, that can help, that does it every day, that can help you prepare.
Exactly.
Sorry to interrupt you, Daniel.
But when we're talking about casinos, to give some of the skeptical people an example, Markets are getting shakier and shakier, right? And the last 5 years have been unrealistic return numbers, right? They've been, especially the NASDAQ has just been crazy. And there's been a few stocks, right? Tesla, Microsoft, Amazon, Apple, Netflix, Facebook, right? These have been some of the companies that have dragged that up. And two of them have been murdered.
Right.
Have been murdered.
Terrible.
Like unbelievable. And Google just missed by a huge margin on earnings. And I actually saw a little article today that was saying companies made so much differently because Microsoft hasn't got slashed yet, where some of these other ones that have been dragging us along.
Haven't made any money, but they haven't got slashed.
This is like the no. Microsoft hasn't. So like Facebook has,
Right.
Google
Right.
missed,
Right.
Netflix. Okay, Netflix talk about casinos. They went to their earnings call. The stock lost $50 billion of valuation, billion dollars in valuation in 2 hours. And most of that was while markets were closed. Okay. Does that sound right to you that
Nope.
your company, because we hear people say, I'm going to watch the trigger. You can't do anything if the market's not open.
Right. And those are the major stocks that have been driving the stock market. And I want to talk more about that, but I want to let you know in our listening audience that you're listening to Agemy Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We have a paper we'd like to give you to help educate you more on this, which is why investing in mutual funds could jeopardize your retirement. A lot of stuff about mutual funds that people think that's an easy and more conservative way to go, but there's really things you need to know about that. I'd love to put this in your hand, why mutual funds are not the best for your retirement. Call 800-725-7616. Daniel, talking about that, this casino thing that we're talking about, Facebook down 25%, went down 25% in one day. Netflix 35% in 2 hours while the markets were closed. Plus these other companies that, Google is off on their earnings projections. Microsoft may be holding its own, but certainly not growing. So, this is crazy, right? They're not built, these companies, when they were growing prior to now they're going the other direction, but when they were growing, they weren't even growing because of, building them out a better mousetrap, so to speak. They were building a better product, right? They were growing. Why?
Well, each one is its own, like Netflix, we're talking about Stupidville. Netflix is just like it's financial engineering. Netflix, the price is not based off earnings, it's based off subscribers. And it costs them so much money to build the content that they have. And then that sits as an asset. But how is that an asset? Like, what is a TV show that everyone's watched worth to you 5 years, down the road, right? So they spend all this money, and so different things. Another one that everybody loves, right, is Apple, the biggest publicly traded company in the world. And this is a company that it makes perfect sense if you stop back and look at it objectively. Why has it gone up so much lately? There's P and E, right?
Right. Price and earnings.
The multiple expansion just keeps getting bigger. So what's happening is two things. The markets are giving it a richer valuation all the time. But because Apple can issue debt at 0 or 1%, right? They issue debt and then they take that money and they buy back their shares. So now there's less shares. It drives the price up. Well, if you were the CEO and you could do that in your company, just issue as much debt as you want at 0%. Now, most CEOs wouldn't do this because it's their company. They don't want to wreck their company, right?
Right, of course.
But you just issue as much debt as you want. You buy back the shares, and that drives your price up.
Nice.
And what do you own a lot of? And what does your CFO own a lot of? And what do all the execs own a lot of? And what do your
Shares
employees
in the
own
company.
a lot of? You make everybody happy, right? By driving it up. But it's just it's financial manipulation. Like
Right.
Apple's not making better product. Their revenues are not going up. Their price per earning is going up and their price per share is going up, right? But
Right.
the revenues that are actually coming in the company are not increasing like the share price has increased.
Right. So it's inflating the share price, right? It's inflating the value, just like we talk about inflation in our economy. They're inflating the share price, so it's not true growth. It's like inflation in our economy is not, prices are going up, but it's not because of growth. It's just because of the inflation, because it's being inflated. It doesn't necessarily mean it's worth more. So it makes it like a casino. So or a house of cards. Right, Daniel? Because something happens that changes that valuation and boom, it falls apart.
We keep hearing nothing bad can happen to these companies. This is the exact thing happened right with the Nifty 50, right? History just repeats itself. This is
right.
These companies are untouchable. One of them is Kodak, right? Like, look how that worked out. But anyways, like nothing bad can happen to these companies. We keep hearing this. And now you're seeing, wait a second, look at
right.
Two of them just got like taken out back and shot.
Right. Right. And, that's what, if people think about it in the audience, most of the people, the retirees are close to retirement, remember girdles that women used to wear, girdles, right? And so girdle companies in the 40s and 50s, whatever, doing something, but where are they today? They're gone. Certain companies just go away. And maybe they might change their product, like you said, with Eason Kodak, right? I think they're probably still around doing something, but they're nowhere near what they used to be. They were a big time runner, probably even in the S&P 500. But now, they're not anywhere near what they used to be.
They were the stock. They were the Apple, or they were the
right.
Right. And I'm not saying that these companies are bad companies at all, but I'm just saying that these valuations, like we've been saying for a long time, are wonky, and the risk reward is skewed, and it's skewed the wrong way if you're looking to protect your wealth or build your wealth.
Right. And that is the key, that we're not against the stock market. We believe that stock market investing can be of value and it can be part of the diversification. The question is how you invest in the stock market, what you invest in the stock market. These things that we've been talking about is what's in S&P 500 mutual funds and all these different kinds of things. And it can be problematic if you're dependent upon them to preserve your wealth. Well, it's time for us to take a break. And before we go, we'd like to give you a book, Common Sense Income Strategies by Michael Easom. This is going to be a book that will be able to help you to understand how you can have what you need to live on in retirement, to maintain that lifestyle and to not run out of money. We're proponents of making sure that people have what they need to retire and don't run out of money. So in the process, we'd like to give you this book, and you can have it for free, no obligation, 800-725-7616, or hit us up on our website, agemy.com, the two words, agemy.com, and ask for the book for today's show, Common Sense Income Strategies. Our topic today is, you've won the game of life, now what? We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Dad, I thought of this story, and it's kind of funny how it actually relates to a retiree's journey. So yesterday, my brother and I decided to go biking. It was a beautiful day. We're gonna go out ride our bikes, right? So we we drive out like Clear Creek Canyon area, out kind of like Black Hawk, and we're riding our bikes, we're riding up this hill. Now this is a trail that it just basically goes up. And we're climbing up. It's not crazy, right? It's not too rocky. It's pretty smooth, but it's up. And we're climbing. He's getting into biking, so he's learning. We're riding. He's doing good. We're huffing and puffing, climbing. Get to the top, do a couple loops around, and then we go up to the top parking lot. We're looking at all the views. We're on top of the mountain. This looks so beautiful. Look at this. Do a couple tune-ups on our bike. And I'm like, all right, now I'm going to teach you how to go down the hill. This is going to be fun. So we hop on the bikes and we are flying. And now this is where it was nice to know that it wasn't really rocky. It's super smooth and rolling. So we're flying right on the edge of this mountain, flying down, going around all these paths, going off some jumps. You have to be careful because if you jump, the path would curve and you could just jump right off the mountain. So we're flying around, going around these things, zooming down, and then we'd stop and we'd enjoy the views. We never stopped on the way up to enjoy the views because we were focused on climbing up to the top of that mountain, right?
Right.
Stop. Say, how are you enjoying this? How are you? Oh, I love this. This is so much fun. The adrenaline I'm getting is amazing, right? Looking out at all the views, all the mountains around us. I can't believe I live in such a beautiful place. Hop on the bikes, flying around these hairpin turns. Boom, boom, boom. Okay, come down, go around this hairpin turn. I stop, I wait for him. He catches up. I'm like, what is better than this? What is more enjoyable? What gives you more adrenaline than this? And he's like, this is great. And then he goes, oh no, my tire is flat. And this is a perfect example, a good example of a bad example. We didn't have the tools to fix this flat tire. Right? The unexpected happened, and we were not prepared for the unexpected. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We're glad you're with us today. We want to be able to help educate you so that you can make smart decisions that will make sure that you never run out of money in your retirement and you enjoy it. Well, Daniel, that is, boy, I was on the edge of my seat with that story. That's a great, but that's a perfect example. You're going up the mountain, and you're focused and you're doing it. And that's what people do when they're saving for retirement. And then coming down the mountain, once they take care of reach retirement, that's where the enjoyable part comes, coming down the mountain, the adrenaline, the enjoyable, and just looking at all the different things there. But if you're not set up properly, that's not going to happen. And you have a flat, if you haven't done your due diligence and you have a flat tire, well, now you got a problem, right? What I always say to people when you're talking about that is, going, saving for retirement. It's like you're going up the hill, in a 2-seater sports car. And it's a lot of fun, driving up that mountain, in a 2-seater, but you get to that top of that mountain with, that snow cap covered mountain. You look over the edge and it's scary because there's a lot of things are changing. Your schedule's changing, your paycheck's changing, your friends are changing, everything's changing around you. Now you get to the top of the mountain, snow cap covered mountain. Now, what do you do when you're going across that mountain and down? Do you still want to be in a 2-seater sports car, or would you rather have an all-wheel drive a SUV driven by a professional driver that's been there before, that can help you and show you the sights and do all the things that you want to do? That's key, right? Too many times people don't take the SUV approach. They stay in the 2-seater sports car. And that's where you have the problem off the edge problem, right? And that's, running out without not having the tools to fix the flat tire. But that's a great example. But, when we're talking about this retirement, we're finishing up. We're in the last piece of our radio show today, talking about you've won the game of life. What now? What now, Daniel?
Yeah, what now? So you're flying down the mountain, you're enjoying it, right? You've got the experience, you can make all those turns. But what happens if there's something unforeseen and you get that flat tire? In our situation, we weren't too far away from the bottom, and he was just able to, run down to the bottom. And I said, I could ride down and go get you the tube. We had the tools in the truck, the air pump and the tube. But it worked out in that case. But But if that happens to you in your retirement, right, and you're not positioned properly for the unexpected, that can derail you, right? He didn't ride off the edge either with the flat tire. We stopped before that happened. So these are things. How are you positioning yourself? And the way you've built your wealth, the way that people are able to protect their wealth is, typically people build their wealth by taking some really good bets, concentrated bets, right? And so we don't have to explain to people how to do this because they've already done it. The people we're talking to already have the wealth, but typically it's a business, right? You built your business and all your money is in your business, or all at your house in your business, and then you sell those and now you got all this cash. So you go from the best way to build wealth is concentrated bets. And the best way to protect your wealth is to have true diversification.
Right.
Once you build your wealth, you don't want to take concentrated bets because you could lose it all. You
Right.
want to be diversified. And we were talking about Netflix. We were talking about Facebook and how these things have been taken out to the back shed and shot. And probably everyone listening, anyone with investable assets probably owns those two companies. If they know they do or they don't, because it's probably in one of the funds that they own.
Right.
And they probably own the other ones we talked about too, other than maybe Tesla, because Tesla hasn't made it into like every single fund yet.
Yeah.
But did you know you own that, and did you want to have that exposure, right? Is that
Right.
diversified? If every fund you own owns the same accounts, I mean, the same stocks, is that diversification?
Right. Right. Well, Daniel, thank you. I want to talk about negative correlated assets and which is part of diversification. But first, I'd like to offer you and our listening audience the report called the Income Generation Report, and how you can be able to have income in your retirement that help. This is one of the options you have for now. What is creating income from your investments? There's also some other things. True diversification, like Daniel's talking about, is one of those things. And then there's some other aspects that you can get involved with other than the stock market that will still give you true growth and help you. But we'd like to put this income generation report in your hand, and you can have that by calling 800-725-7616. And you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, you've won the game of life, now what? So we'd love to put this in your hands so that you can have that. 800-725-7616. Daniel, negative correlated assets, always having something going well and something that is maybe something's not going well, but when something doesn't go well, you got something doing well, right? So there's things that can go up when the market's going down and vice versa, but there's also things that can not, they can go up when the market goes up, but they don't come down when the market comes down, right? They just stay the same. So these are some of the diversifications, right, that are important.
Right. And this is where it really it's important that you get a second opinion, that you look at your situation, make sure it's good. Because we talked about what people are expecting that they're going to need to live on. And this is before all these crazy inflation things that have happened. You're going to need $60,000 to $100,000 a year to live off of. How do you get that? So some people build their own kind of pensions, right?
Right.
And to start this is good the sooner you can, because we have people who are retiring now, and they're activating these things, and we have multiple people that are doing this right now, and they're around 10% of what they originally put into the account. So think about that. 10% for the rest of your life of what you put into the account, right?
Guaranteed.
Yeah. So that works for some people, especially for the people who don't have pensions, who have accumulated wealth, but their Social Security is not going to be as much as what they need to live off of, right? That's one way. Now, that's not negative, Corey. That's not going to go up because markets come down, but you still get your paycheck, and you get to decide, do I want to cash this in for lifestyle chips? Do I want to go on vacation, even though everybody else is freaking out about markets crashing? Or do I want to take advantage of opportunities that are presenting them to me? Because you can invest that, you can spend it, you can give it away, you can do whatever, you can pay your RMDs, whatever you'd like to do, right? That's one way that a lot of people we see like to protect a portion of their money that way. That's having all the tools you need in your backpack. So when you get that flat tire, it doesn't affect you. Just pop, 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 and keep riding down the mountain, right?
Yeah. Yeah. And that's what financial strategies is all about. It's not about as much of the investments of what you're investing in, as about how you invest it, the methodologies, the strategies that you use for doing that. And by putting these things together, you can prepare yourself to be able to preserve your assets and go further. Earlier, Daniel, we talked about the illustration of the house insurance and reevaluation of the house insurance and that kind of thing. And by doing these things, you and our listening audience, that by doing these things that we're talking about, it's kind of like putting together an insurance plan for your retirement portfolio. A way that you can ensure or assure that you don't run out of money for the rest of your life, that you have everything that you need, that you're able to retire and stay retired. I mean, who wants to retire from retiring and have to go back to work, right? So, there are ways to ensure your retirement portfolio if you do it properly, but you're not going to hear those from Wall Street, from the talking heads, from the non-fiduciary standard people that are out there. You need to be able to get the right advice from the right people and make sure you're asking the right questions.
It's like the CEO that's issuing debt to buy back their shares to drive the price up. It benefits them. So what do you think they're going to preach? Right. What do you think they're going to talk about? The thing that's benefiting them. So if you listen to Larry Fink talking about BlackRock, right, and probably everybody listening has BlackRock funds when they know it or not, because iShare is BlackRock, right? All these different things are BlackRock. What do you think they're going to do? They're going to do the things that are benefiting them, their company, their shareholders, not necessarily you. Now, there are good financial people out there. So if you have a fiduciary that's watching out for you, hold on to that person. But in general, there's things that are being pushed upon people, and we've seen it so many times in these different market crash where these structured products come to be, and then the regular Joe loses their money, right? So the only people that make money on rich, the bankers get bailed out by the taxpayers, but so check, just like the insurance policy.
Yeah, Daniel, you bring up structured products. I gotta, whenever what I say to people is the only people that make, generally speaking, money on structured products are the people that structured them. The people that designed them, the people that sold them originally, not the people who invest in them or buy them. So be careful with structured products. Anyway, I see that we're coming to a close for today. Been a great time. Daniel, thank you for your expertise and help. And for you and our listening audience, Common Sense Income Strategies, the book we're offering today. Love to put this in your hand. You're going to get it's going to be a good read. You're going to enjoy what Mike has to say to you about how you can have the eggs that you need, the resource, the generating resource that you need, the income that you need. Thank you. I'm struggling here. Help me, please, Jesus. Anyway, the renewable resource that you need to be able to live the rest of your life. We'd love to put this in your hand. You can have it by calling 800-725-7616. No obligation, free of charge. 800-725-7616. Thank you for listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. You listen to today's show, now you know something different. You too can have a stress-free retirement. Bye.